All right, we are now getting that Federal Reserve decision. Want to check in with our Fed correspondent, Brian Cheung, to break it down. What is the Fed saying, Brian?
Well, Alexis, no surprise, the Federal Reserve holding interest rates steady at near zero. No new announcement on the Federal Reserve's quantitative easing program. Again, that $120 billion a month pace of absorbing U.S. Treasuries and agency mortgage-backed securities. Now, keep in mind, we did not get a set of economic projections with this statement. So it's just the words that we have to work with so far, at least for the next 30 minutes. And some notable changes in the FOMC statement with regards to how they are viewing the economy. The statement now saying, quote, amid progress on vaccinations and strong policy support, indicators of economic activity and employment have strengthened. The word strengthened is new language compared to the March statement in which it said that economic activity and employment have turned up recently. So it seems like that pace has continued at least through the last 6 weeks. And some other interesting new language was that the FOMC now saying that the sectors most adversely affected by the pandemic remain weak, but have shown improvement. So the improvement language is new compared to March. As we've heard from Fed officials, those most adversely affected industries might be those like hospitality and food and dining services. So it seems like the Fed's seeing some green shoots on those fronts. And then the last thing worth noting is, of course, inflation. We saw the tick up in the CPI figures. We're getting a new print on core personal consumption expenditures this Friday. The Federal Reserve saying that it already sees inflation as having risen, but it says that it's largely reflecting transitory factors. Again, not a surprise. We've heard Fed officials trying to talk down any sort of high inflationary readings because of base effects. Obviously, the year-over-year comparisons can be quite noisy because we're crossing the one-year mark of the COVID crisis having begun in this country, in addition to all the supply chain effects that we've seen weigh on prices across the board. So on the whole, it seems like the Federal Reserve saying that they do see more optimism. That's also reflected by the last change that I want to note here. The Federal Reserve now saying that the ongoing public health crisis continues to weigh on the economy and risks to the economic outlook remain. That might not sound new, but that is a change from the Federal Reserve's language in March, where it said that the Federal Reserve, or the economy, was facing considerable risks. So the Federal Reserve striking the word considerable, now saying that just risks face the economy. So that seems to be an upgrade. But again, from everything else in the statement, you can compare it right up to the March statement. It's exactly the same. It was a unanimous decision, so no dissent on that front. But again, all the color that we'll probably get that's interesting will likely be from the Federal Reserve Chairman himself in about 28 minutes or so. But again, the headline news, no change to interest rates at near zero and quantitative easing still at that $120 billion a month pace, Alexis.
Brian, got it. So no changes to interest rates. But what about the labor market? So we're seeing signs of improvement, but the unemployment rate is still high. Brian, what are you gauging from the Fed in terms of how they're looking at the labor market picture right now?
And Sambil, I think that's exactly where we expect to get more color from the Fed chairman. In a canned statement with as many as words as this, you can't get into the nuances of not only how there are more than 8 million people still out of jobs compared to pre-pandemic levels, but the fact that the labor market recovery, at least so far, is also extremely uneven when you consider the impact to women and minorities, Black communities, for example. I think that's something that the Federal Reserve Chairman is going to underscore when he says this is the reason why we're not paring back on the unprecedented amount of aggressive monetary stimulus that we've been providing so far. That's because the Federal Reserve now says it would like to hold that stimulus for longer so that it can pull those marginalized groups back into the labor market. So yes, it is indeed the case that we got 1 million job gains in the month of March. That was a new piece of data that we got over the last 6 weeks since the Fed's last meeting. And the Fed chairman has said since that point in time that he would like to see multiple months, or a string of months is how he described it, of those types of reports and job gains in order for the Federal Reserve to assess that they are making substantial further progress to a point where maybe they could start to pull accommodation. But for what it's worth, we've heard some Wall Street analysts and some Fed watchers who have said we wouldn't expect to get a signal from the Federal Reserve about even pulling that back, thinking about pulling back that quantitative easing until maybe the second half of this year for a tapering process that might not begin until early 2022. So it seems like for right now, the Fed reiterating its patience, and I think the Fed chairman will likely use the P word in that press conference happening in about 26 minutes or so.
Well, Brian Cheung, we love it as always when you decipher exactly what the Fed means when they put out that statement. Thanks so much.